their auditors discovered the fraud mid-audit. Then they resigned and sent a letter explaining everything. In May 2011, Deloitte, one of the 4 largest accounting firms in the world, resigned as auditor of Longtop Financial Technologies mid-engagement, not at the end of an audit cycle, not after filing a report. In the middle of conducting the annual audit, they stopped, resigned, and sent a letter to Longtop's board of directors that described, in unusually explicit detail, exactly what they had found and why they were leaving. The letter described bank officials telling Deloitte representatives directly that account balances did not match what Longtop had been reporting. It described Longtop's own finance staff attempting to physically obstruct the audit. It was one of the most extraordinary documents in the history of public company accounting. This is the story of what was behind it. To understand why the Longtop fraud was so significant and why it attracted so little scrutiny before Deloitte walked out, you need to understand what Longtop appeared to be and why that appearance was so appealing to investors in 2010 and 2011. Longtop Financial Technologies was a Chinese software company based in Xiamen, founded in 1996. Its business was providing financial software, core banking systems, teller systems, fund management platforms, to Chinese banks and financial institutions. In a country where the banking sector was enormous, rapidly modernizing, and deeply committed to upgrading its technology infrastructure, the market Longtop was serving was genuinely vast. The company had listed on the New York Stock Exchange in 2007, and its stock had become one of the more popular Chinese technology plays among American institutional investors. The reasons were straightforward. Longtop reported extraordinary financial metrics, profit margins well above industry averages, revenue growth that consistently outpaced its peers, and a balance sheet that appeared to be accumulating cash at a remarkable rate. Its gross margins, in particular, were the kind of numbers that software companies dream about, but rarely achieve sustainably, consistently above 60%, in an industry where competitors were reporting margins in the 30 to 40% range. The chairman of Longtop was Liang Hanqing, a founder-operator who had built the company from its early years and whose control of the business gave him, as was common with Chinese companies listed on American exchanges, significant authority over its operations and reporting. The company's management presented its extraordinary margins as evidence of a competitive moat, proprietary software that Chinese banks found indispensable and for which they were willing to pay premium prices. Analysts who covered the stock largely accepted this narrative. The institutional investors who owned Longtop shares similarly accepted it. Nobody looked closely enough at the mechanics of how those margins were actually being generated. And here is the part that should have triggered more questions earlier. The cash that Longtop was supposedly accumulating on its balance sheet, the product of those extraordinary margins over several years of reported profitability, was sitting, according to the company's financial statements, in Chinese bank accounts. For a company of Longtop's reported scale, the cash balances were large, but not implausible on their face. The problem that Deloitte would eventually discover, was that the cash was not there. The accounts existed. The balances reported in Longtop's financial statements did not match the actual balances that the banks held in those accounts. The difference was approximately $180 million. The mechanism by which this discrepancy had been concealed for years relied on the same structural opacity that had protected other Chinese reverse merger and listed company frauds of the same era. The practical difficulty of independently verifying bank account balances in China, combined with the willingness of someone inside Longtop to intercept and replace the bank confirmation documents that auditors sent to Chinese banks with fabricated versions showing the inflated balances. For years, it had worked. Then Deloitte changed their procedure and went to verify the accounts directly. The specific sequence of events that led to Deloitte's discovery of the Longtop fraud began when Deloitte's audit team, conducting the annual audit for the fiscal year ending March 2011, attempted to verify Longtop's bank balances through direct confirmation with the relevant Chinese banks. The standard audit procedure for verifying cash balances involves sending confirmation requests directly to banks, letters asking the bank to confirm, in writing, the balances held in specific accounts as of a specific date. In Longtop's case, the confirmation process had historically proceeded smoothly, with responses arriving that matched the balances Longtop reported. What the audit team had not known was that those smooth responses had been facilitated not by the banks confirming genuine balances, but by Longtop's own staff intercepting the confirmation requests and providing falsified responses. When Deloitte moved to conduct confirmations through a process that bypassed Longtop's internal mail handling, going directly to banks rather than routing through the company, the responses they received told a different story. Bank officials at multiple institutions told Deloitte representatives that the balances in the accounts did not match what Longtop's financial statement showed. The discrepancy was not small or ambiguous. It was fundamental. The cash that was supposed to be there, approximately $180 million, was not there in the amounts reported. Remember this number, because what came next made the situation significantly worse than a missing cash balance. When Deloitte attempted to continue the audit and gather additional information to understand the discrepancy, they encountered obstruction from Longtop's own management and finance staff. According to the resignation letter that Deloitte subsequently sent to Longtop's board, the company's head of finance had told Deloitte that the audit was going to be terminated, that Longtop's management was ending their relationship with the auditors. This was, in Deloitte's assessment, an attempt by Longtop's management to shut down the audit before its findings could be formalized and reported. Deloitte did not comply. Instead, they resigned first, taking the initiative to terminate the engagement on their own terms before Longtop could dismiss them, and ensuring that the resignation letter they sent to the board would become a public document that investors and regulators could examine. The letter, which was disclosed to the SEC and released publicly, described the interception of bank confirmations, the discrepancy between reported and actual cash balances, the obstruction they had encountered, and Deloitte's conclusion that the situation was inconsistent with continued service as Longtop's auditor. It was an extraordinarily candid document by the standards of how accounting firms typically communicate about client relationships, and it left essentially no ambiguity about what Deloitte believed had happened. The public release of the Deloitte resignation letter triggered an immediate market response. Longtop's stock, which had been trading at around $18 on the NYSE, collapsed. Trading was eventually halted by the exchange. The SEC launched an investigation, and Liang Hanqing, Longtop's chairman, did what the founders and executives of several Chinese companies facing fraud exposure had done in the same period. He disappeared. Here is what most people never learn about this case. The resignation letter that Deloitte sent was so detailed and so damning that it essentially did the regulator's job for them. What it revealed about how audits actually work and how they can fail changed the profession. Stay with me. The Deloitte resignation letter, dated May 22, 2011, was addressed to Longtop's board of directors and disclosed publicly through an SEC filing that same day. Its language was, for an accounting firm's formal correspondence, remarkably direct. It described the discovery that Longtop's cash confirmations had been falsified. It described the conversations with bank officials who had confirmed that account balances did not match the company's reported figures. It described the attempt by Longtop management to obstruct and terminate the audit. And it included a statement that Deloitte had concluded, based on what it had found, that it could no longer serve as Longtop's independent auditor. The letter also described something that went beyond the specific cash discrepancy, a pattern of behavior that Deloitte said suggested the problems at Longtop were not isolated but systemic. The firm noted that Longtop's management had made statements during the audit process that were inconsistent with the evidence Deloitte had gathered independently. It noted that the obstruction it had encountered was not a misunderstanding, but an apparent deliberate attempt to prevent the audit from proceeding. And it noted that the cooperation it was legally and professionally required to receive from an audit client had not been forthcoming. The NYSE halted trading in Longtop's shares on May 17, 2011, as Deloitte's concerns became known to regulators before the resignation letter was formally filed. By the time the letter was public, the company's stock had effectively ceased to have a functioning market. The SEC launched a formal investigation. The exchange moved toward delisting. Longtop's management issued statements denying wrongdoing and asserting that the company's financial statements were accurate, assertions that were difficult to reconcile with the Big Four auditors' formal written conclusion that the cash confirmations had been falsified. The case was unusual in the landscape of Chinese company frauds of that period for the clarity and speed with which the exposure happened. In most cases, Sinoforest, Wirecard, Luckin Coffee, the collapse followed a period of contested allegations, management denial, independent review, and gradual market repricing as the weight of evidence accumulated. At Longtop, the exposure was essentially instantaneous because the party that discovered and disclosed the fraud was not a short seller or a journalist, but the company's own auditor, whose professional obligations required immediate and transparent communication with regulators and the board. The Deloitte resignation letter was, in effect, a contemporaneous account of fraud discovery written by the people who had found it, a document of unusual evidentiary value and unusual candor. What it also revealed, uncomfortably, was a vulnerability in the standard audit process that had allowed the fraud to operate undetected for years. The bank confirmation process, one of the most basic and fundamental procedures in any audit of a company with significant cash balances, had been successfully subverted by a relatively simple interception scheme. For years, auditors had accepted confirmations that appeared to come from banks, but had in fact been created or altered by Longtop's own staff. The revelation prompted serious questions across the auditing profession about whether standard procedures were adequate for auditing Chinese companies, and about what reforms were needed to address the specific vulnerabilities that the Chinese corporate environment presented. The aftermath of the Longtop collapse was, in terms of legal consequences for the individuals most responsible, frustratingly limited, a pattern that had become familiar in the wave of Chinese company frauds that characterized the 2010 to 2012 period. Liang Hanxin, who had disappeared in the immediate aftermath of the Deloitte resignation, relocated to mainland China, where he remained beyond the practical reach of American legal process. The SEC filed civil fraud charges against him and other Longtop executives. Those charges could not be enforced against individuals who had no presence in or assets subject to American jurisdiction. The practical result was that the person most directly responsible for the fraud that had destroyed hundreds of millions of dollars of investor value faced no meaningful legal consequence. Longtop itself was delisted from the NYSE in August 2011, approximately 3 months after Deloitte's resignation. The company ceased to function as a publicly listed entity. Its assets in China, the software products and the customer relationships that had formed the basis of its legitimate business, had some residual value, but the collapse of investor confidence and the ongoing regulatory investigations made any orderly realization of that value essentially impossible in the short term. Investors who had held Longtop shares suffered losses that were, in most cases, total. The stock became worthless before most shareholders had an opportunity to exit. The consequences for the auditing profession and for the regulatory framework governing Chinese companies listed on American exchanges were more significant and more durable than the direct legal consequences for Longtop's executives. The Longtop case, alongside Sinoforest and a cluster of other Chinese company frauds exposed in the same period, became central evidence in the regulatory and legislative debate about the audit oversight gap that existed for Chinese companies. American securities law required that the auditors of public companies be subject to oversight by the Public Company Accounting Oversight Board, the regulator established by Sarbanes-Oxley to inspect and regulate audit firms. China, however, had not permitted the PAB to conduct inspections of Chinese audit firms, citing national sovereignty and state secrets concerns. This regulatory gap meant that the audit firms conducting the work for Chinese companies listed in America, including the Chinese affiliates of the Big Four firms like Deloitte, were operating in an environment where the standard quality controls and regulatory checks that applied to American audits did not apply. The Longtop fraud, where the basic bank confirmation procedure had been subverted for years without detection, was a direct consequence of this gap, and a compelling illustration of why closing it mattered. The pressure generated by the Chinese company fraud wave of 2010 to 2012 eventually contributed to the Holding Foreign Companies Accountable Act, signed into law in December 2020, which required foreign companies listed on American exchanges to submit to PAB audit inspections or face delisting after 3 years of noncompliance. Negotiations between American and Chinese authorities on audit oversight continued for years, eventually producing a landmark agreement in 2022 that allowed PAB inspectors to conduct inspections of Chinese audit firms for the first time. The resignation letter that Deloitte had written in May 2011 had set in motion, through the accumulated weight of the cases it represented, a decade of regulatory change that fundamentally altered the relationship between Chinese companies and American capital markets. Before we finish, drop one word in the comments. Deloitte found the fraud and resigned rather than covering it up. Does that make them heroes in this story? Or does the fact that they missed it for years make them part of the problem? One word: heroes or complicit. I read every single one. Deloitte found the fraud because they finally went to look themselves. The next CEO we're covering made sure nobody could ever look at all. He controlled everything. Subscribe.